Inside almost every big company, there's this quiet, high-stakes war happening constantly. And it's not between marketing and sales. It's between the two groups that fund the whole operation, the owners and the lenders. And how this hidden war plays out, well, it determines the fate of billions and billions of dollars.
It really all boils down to this one simple question. How is it that one company can borrow money at a fantastic rate, while a nearly identical company, maybe just down the street, has to pay an absolute fortune in interest just to get a loan? What is the secret ingredient that lenders are really looking at?
Well, a really fascinating study from 2016 suggests the answer isn't just about how much profit a company makes or how cool their product is. Nope, it's all about the identity of the people and the institutions who own the company's stock. It turns out, lenders are watching the shareholders very, very closely. So, to really get how this all works, here's how we're going to break it down. First, we're going to look at that fundamental conflict between owners and lenders. Then, we'll meet two totally different kinds of investors. We'll see how they directly impact borrowing costs, figure out when that impact is strongest, see how corporate power changes the game, and then we'll finish up with a final pretty surprising twist.
Okay, let's jump right into part one. This basic conflict of interest that's just baked right into the DNA of pretty much every company. Owners versus lenders.
What's so wild is when you see it laid out like this, you realize these two groups are playing completely different games. On one side, you have the shareholders, the owners. They want to maximize the company's value, right? So they have a huge appetite for risk. Why? Because if some risky bet pays off big, they get all of that upside. But the lenders, the bondholders, they have a totally different goal. Just get their money back plus the interest they were promised. That's it. They have basically zero appetite for risk because they don't get a single extra penny if a risky bet pays off, but they could lose everything if it goes south.
The researchers, Huang and Petkovich, they put it perfectly. From a financial perspective, shareholders are basically holding a call option on the company. And what that means, in plain English, is that they are fundamentally wired to push for more risk. They want the company to swing for the fences every time, while the lenders just want them to hit a nice, safe single.
So how does this all play out? Well, it gets way more complex, because it turns out that shareholder group isn't just one big monolith. We actually need to look at two very distinct types of investors.
On one side, you've got what we can call the sprinters or short-term institutional owners. These are the investors who are constantly buying and selling. They have a really high turn rate. Their whole focus is on quick, near-term profits. But on the other side, you've got the marathon runners or the long-term institutional owners. They have a really low turnover rate. They buy a stock and they hold on to it, focusing on the fundamental long-term health of that business.
And these are not small fringe groups we're talking about. In the average company, as you can see here, these long-term marathon runners hold about 45% of the shares. The short-term sprinters hold about 26%. So you can see right away, the balance of power between these two groups could totally shift a company's entire strategy.
And that brings us to the absolute heart of the matter. How does this specific mix of sprinters and marathon runners actually affect what a company has to pay to borrow money?
Okay, first, just a real quick definition so we're all on the same page. The key thing to watch here is the bond yield spread. Just think of it as a risk premium. It's the extra interest a company has to pay on its loans compared to what the super safe U.S. government pays. So a bigger spread means lenders are seeing more risk and they're demanding more cash in return.
And here it is, the first major finding. The data is just crystal clear. As the percentage of those short-term sprinters owning a company goes up, that company's borrowing costs, that bond yield spread, it goes up right alongside them. Lenders see all these short-term focused owners and they get nervous. But, and this is so cool, look what happens when you flip it. As the share of those long-term marathon runners goes up, borrowing costs go down. Lenders see these stable, long-term investors as a really good sign, a sign of a healthy, predictable strategy, and so they're willing to lend their money out for cheaper.
And we're not talking about pennies here. The study found that a standard increase in long-term ownership was tied to a drop of 16.6 basis points in borrowing costs. Now, that might not sound like a lot, but for a company that's borrowing billions of dollars, that translates into millions of dollars in real savings every single year.
But of course, the story gets a little more nuanced. Let's dig into when these effects are at their absolute most powerful. You can think of this next part as adding an accelerant to the fire. So, naturally, the researchers asked, does this rule always hold true? Or are there specific times when the type of owner you have matters even more?
And, well, the answer was a definite yes. The impact gets magnified, way bigger, when a company is already seen as being risky.
Just look at this breakdown. The negative hit from having those short-term sprinters, it's strongest when a company is already in hot water, when it's at high risk of financial trouble, or when its stock is all over the place. It's almost like lenders see those sprinters as pouring gasoline on an already burning fire. The positive effect of the long-term marathon runners, though, is much more stable. It's a benefit that helps pretty consistently, whether the company is sailing on calm seas or navigating a storm.
But hold on, there's another factor that can come in and change this entire game. Things like power, governance, and the threat of an outside takeover.
See, the possibility of a hostile takeover. It can keep a company's management team on its toes. It's a really powerful form of external discipline. But what happens at companies that are protected from takeovers? Places where that external threat is really weak. Who holds the power then?
Now this is a totally fascinating and pretty counterintuitive result. When that external threat, that external discipline, is weak, the influence of the investors you already have becomes much, much stronger. The negative impact of short-term owners gets even worse, and the positive impact of long-term owners gets even better. In other words, when there are no outside checks and balances, the true character of the owners you've got matters more than ever.
And that leads us to our final, and honestly the most surprising twist in this whole story. This is the point where that simple narrative of long-term investors are good gets, well, a lot more complicated.
Okay, so check this out. That benefit we talked about, the one from those good long-term marathon runners, it only seems to work when their ownership is spread out, diffused among many different institutions. But the second that ownership becomes concentrated, when one of those good long-term investors owns a massive chunk, like over 5%, the benefit just vanishes. Poof! In fact, the study found that concentrated ownership by any type of investor, short or long-term, actually makes lenders nervous and drives borrowing costs higher. Too much power in any one shareholder's hands is seen as a major risk.
Which leaves us with this final thought. It really seems like lenders believe in the wisdom of the crowd, even a crowd of good long-term investors. They prefer spread-out power over concentrated control. So it really makes you wonder, if a long-term investor is supposed to be a company's best friend, at what point does their power actually make them its most expensive ally?